Hi everyone, Melvin Jason De Vera here, and this video lecture will tackle about basic stock valuation. So when we say stock valuation, we're going to compute the stock's intrinsic value, and we're going to compare it with the prevailing market price so that we can determine if the stock is undervalued or not. So as we know, what we wanted to buy is the undervalued stock. All right, so with that, we need tools. First, let me show you an Excel template. So you can actually create a template like this, okay, wherein you're going to put the stock, all right, and then the stock price. This is the market price right now. And we can formulate the cell for intrinsic value. All right, so let me again recap how do we do that. Okay, so when we say intrinsic value, okay, we actually get the stock's present value of its expected future cash flows. All right, so again, this is the present value of all expected future cash flows or cash inflows, should I say, from the stock investment. Okay, so what are basically your cash inflows that you expect? First, you will have a dividend, all right? You expect a dividend, and there will be a target price. Okay. Now, the assumption here is that you're going to buy the stock right now, and you're going to hold it for 1 year. So it's our timeline 0, all right? And then we have a 1 year. Okay. So this is when you will pay, right? So this is your cash outflow. You're going to buy the stock. Okay. And basically, this is the amount of price of the stock per share today. And then here you will get your dividend plus the selling price next year. And this cannot be compared with your cash outflow here because this is in the future, while that one, no, the cash outflow is actually at present. So you need to bring this to the present, okay, by discounting it. So in our time value of money, before we have learned that when we solve for future value, this is present value times 1 plus I raised to n, wherein this is the present value, this is the interest rate, this is the number of terms, and you get the future value. Reversing the formula, getting the present value is future value divided by the 1 plus I raised to n. Okay. However, n is the number of term. If that is 1, because it's 1 year, then you can actually remove that. Okay. But I, interest rate, is not applicable. Why? Because this is stock investment, and interest is not the appropriate discount factor for that. Okay. So that being said, we're going to use the required rate of return using the CAPM or capital asset pricing model concept. So wherein we get K, which is the risk-free rate, times the beta of the stock, plus the beta of the stock times the expected market return minus the risk-free rate. So again, what is K? This is the required rate of return. Okay? And this will be calculated using this formula. The risk-free rate, which is the Treasury bills rate, okay, plus the beta of the stock, which is the sensitivity of the stock to the market, times the difference between the market return and the risk-free rate. So the difference is what we call the risk premium. Okay. The expected market return is basically our PSEI return or the composite index. Okay. So that is the concept. Now, why are we getting the risk premium? Because let's say your money is invested in the Treasury securities. It's making modest earnings based on the risk-free rate, and you are transferring it to a stock market that has a higher risk. So you're going to compute the difference. That's going to be your risk premium. Now, the stock has its own inherent risk or systematic risk, and that is the beta. That's why we're going to multiply the beta with the risk premium and then add back the risk-free rate to get the required rate of return. And this is what we will use in replacement of I. All right? So that's why we have to compute for the discount factor. Okay, and then this is what we will use to discount both the dividends and the price that we expect next year. Okay, now, further concept of the CAPM. If the beta of the stock is actually flat 1, then your K, okay, the required rate of return can be equals the market return. But if K is greater than your market return, when will it happen? That is if beta is greater than 1. So you will not be contented with the market return being your required rate of return because the systematic risk is greater than 1. All right. So the thing is, where are we going to get the data? Okay, so I will explore you to different sites. One is coifin.com. This is where we may get the performance of the PSEI. And then we get the risk-free rate from Treasury. And we can use investing.com to get the beta of the stock. Okay. Then we can get estimates of the EPS and the PE ratio from Coifin as well. The dividend yield can be sourced from Coifin as well. All right. That being said, I will explore you to sites where you can get data that needs no paid subscription. Although in Coifin, there is an option to upgrade from free to basic, but you actually don't need to if you're just doing basic valuation. Okay. So let's get started. So assuming we're going to analyze JFC, just Jollibee, all right? So we look at the price of Jollibee right now. So we go to the, okay, let's go to the website. Here you go. So investing.com, I'm going to type Jollibee here. All right. Loading. All right, there you go. So I'm going to scroll down. That's 223. So I'm going to put that here, 223. Okay. So we get the expected market return and we get it from Coifin. So let's go coifin.com, right? So you can actually sign up or log in. But in my case, since I already am logged in, I already created an account, so I'll just sign in. So upon signing in, you will see there your watch list. You can actually customize everything. You can customize your dashboard, your watch list, etc. But since, as for me, I trade different instruments. I trade equities, forex, commodities. So that's why I have a lot of instruments displayed, both in my dashboard and in my watch list. All right. So here, let's look at the PSEI. So there's a search bar here. You just have to type, let's say, PSEI. All right. So PSEI is equivalent to PComp. That's the same symbol for Bloomberg. It's for Philippine Stock Exchange Composite Index. That's why it's called PComp. All right. Now, loading the PComp, what I want is to get the performance graph. All right. So in the performance graph, you need to make this yearly, and I suggest 10 years. But if you are not yet there, I guess you have to click all and then click this to yearly. All right. So again, start from displaying all and then make it yearly and then go to 10 years. There you go. Why 10 years? Because what I will recommend is to get the 10-year Treasury yield. So you can at least match it. That's quite long term. All right. So you will see a better view of a bigger picture. All right. So now we have here pickup as 12.45%. All right. So we will take that as our expected market return. So we're going to put that now to our Excel. So this is 12.45. And make sure you format that in a percent. Okay. So now we're going to get the Treasury rate. All right. So we go Bureau of Treasury. So this is treasury.gov.ph. All right. So from there, you just scroll down. Go to the PDEX. This is Philippine Dealing and Exchange System. Fixed Income Market Summary. And as mentioned, you get the 10 years. So it matches the tenor of your performance of PSEI. So we get 6.216%. Okay, so we go back here. So this is now 6.216%. All right, so reviewing earlier, if beta is 1, then your expected market return is same as the required rate of return. But then we are going to take a look at the actual beta of Jollibee. So let's go back. Okay. Jollibee, all right, scroll down. There, the beta is 1.03. So we're gonna go there to our Excel and put 1.03. All right, so now we have our required rate of return using the equation risk-free rate plus beta times the quantity of market return minus the risk-free rate. Okay, so I suppose you also know how to formulate your Excels. All right, I mean the cells in your Excel. There you go. Okay, for the price. Okay, now that we know it, next thing is we get the EPS next year and the price to earnings ratio next year. Why? Because we need to get the price target. And how come the price target will be the product of this? Okay, reviewing PE ratio, that's price divided by the EPS. That's why it will become PE ratio. Okay, now if we cross multiply this, then you get the price. Therefore, that's PE ratio times EPS equals price. But that is just like reversing the formula. But what we want to get is the price next year. Therefore, you have to get a PE ratio next year and an EPS next year. So when you multiply these two, then you will get the price target next year. This will be your own target price as an analyst. Other analysts may have their own target prices and may have their own way of computing it, but this is good enough. All right. So now that we need to know the EPS and PE ratio, all right, then we just go to the COIFIN, all right. So going back to COIFIN, all right, this time I'll have to load Jollibee here. Search Jollibee. There you go. And then go to snapshots and overview. There you go. So again, load the stock here and then go to snapshot and then overview, and you will already see a lot of data here. Okay. So first we need to get the EPS. So you look down here. Okay. So we have here 2023, 2024. And since we are already in 2023, what we wanted to get is the 2024. So we will get the EPS 2024, which is 10.5. All right. There's no percent. It's an EPS. All right. So we go to our calculator. We put 10.5. Now we need to get the PE ratio. Okay. So PE ratio, where is it? All right, show yourself. Okay, there you go. So you have two PE ratios here. There's an LTM, like last, and then this is N next. You want to get the next. All right, so 27.1 times. All right, so go to your Excel, and we put here 27.1. Yeah. So now we have the price next year, the target, or our estimated price next year, 284. But once again, we cannot compare 284 with 223 because this is at present and this is at future. All right. Actually, it primarily computes the intrinsic value using just this one, but we don't forget that we still have a dividend to expect next year. So we also include that in the equation. Now, to get the expected dividend next year, you need to get the dividend yield and just multiply it with the price so that you can get the dividend next year. All right, so look at Coifin again. Dividend yield is 1.10%. So now you're going to go back here and put the dividend yield 1.10%. All right, so now we have the dividend next year, which is 3 pesos and 13 cents. And that being said, now we discount both the dividend next year and the price next year to the 1 plus K. This is your future cash inflows. This is your discount factor. And you get an intrinsic value of 255.4. That being said, this is undervalued. All right? Because the market is just valuing it at 223. Okay, so the 223 is the price that you will pay, whereas this is the value that you are really getting. This is the intrinsic value. The stock price is more like the perceived value, while the intrinsic value is the true value of the stock. Therefore, this is recommended to buy for a 1-year term, okay, at this price. Okay, however, the analysis, okay, does not guarantee profits. So this just a disclaimer, even if you, let's say you buy right now, we are not certain, all right? We don't have the capacity, even if we are analysts, we don't have the capacity to really predict the future with certainty. Okay, so trade at your own risk and caveat. Okay, so I hope you learned from this basic equation, and even if, let's say, you're going to apply this to another stock, then just use our sources, use the Excel as your calculator, and you will have an estimate of its intrinsic value. Okay, so thank you. I hope you enjoyed this video lecture and you learned, and stand by for our more lectures to upload. Goodbye.